Imagine I'm an accountant and I'm going to audit a firm, or I'm going to audit a firm, or maybe my father's firm. Do you think I'm going to faithfully capture everything, every wrongdoings of the company?
Watching KS tutorials, they are the best. Guys, keep watching KS tutorials, they are the best.
Hello guys, welcome to KS tutorials. We've been away for long, but now KS tutorials is back. Tell any accounting learner that KS tutorials is back. My name is Mr. Sam and I welcome you to KS tutorials. Okay, so on today's episode, we'll be talking about the regulatory and then conceptual framework. The regulatory and then the conceptual framework. So when we will start with the regulatory framework. The regulatory framework. So when we talk about the regulatory framework, they are a set of rules, principles, laws that guide the preparation of financial statement. So let's say if you want to, as an accountant, you want to prepare a financial statement, you need some rules that is going to guide you prepare them. Those rules or laws or the principles, those rules or laws, yes, or the principles that will guide you through the preparation of the financial statement is what we call the regulatory framework. That is what we call the regulatory framework. Okay, so we have components. We have what we call the components of the framework. We have one, we have the accounting standards. We have the company laws. We have the professional bodies. We have the enforcement agencies. Okay, so we have these four. There are four. So let's of the framework. So we said the accounting standards. So we have standards that in accounting, it guides accountants in their day-to-day activities as in preparing the financial statements and in working for the company. So we have the international one, which is generally accepted worldwide, which is the IFRS. Most companies follow the IFRS or the IAS to prepare the financial statement of companies. And then in US, we have the local one for US. United States, they do not go by the IFRS. They don't use the IAS and the IFRS in preparing their financial statement, but rather they use the GAAP, the US GAAP, which is the generally accepted accounting principles. So the United States, they use the generally accepted accounting principles, but other international or other countries use the international one, which is the IFRS, and then the AIS, which is developed by the AISB. Do you get it? Yes. And then we have company laws. In every country, there are laws that governs the operations of a company. To register as a company, there are rules and regulations that you are supposed to follow. As we said, the regulatory framework is there are rules and regulations. So in every country, they have rules that governs every company operation. So before you operate as a company, we have rules and regulations that you must adhere to, that you must follow. Do you get it? So these are the company laws. For every country, they have their company laws. Even though there might be similarities between other countries, but still every country has their own company laws. And then we have the professional bodies. When we talk about the professional bodies, we are talking about the let's say in Ghana we have the ICAG, the Institute of Chartered Accountants. We have the ACCA, we have those bodies. Those are the professional bodies. So those professional bodies also come up with rules and regulations that companies must follow. As in, if you're accountant in a company, you are supposed to follow those rules and regulations. Do you get it? So let's say if ICAJ go for maybe a meeting, or they decide that, okay, in our company, this is the economic crisis in this company. So when you are preparing a financial statement, you have to do A, B, C, D, and then the accountant in that particular, let's say in Ghana, will have to adhere to that rule or the regulations that has been placed. Even though we have adopted the international, that's the IFRS. Do you get it? Even though we've adopted the IFRS, but we still have to we still have to follow the professional bodies whenever they bring out rules. Do we get that one too? Yes. Okay. And then we have the enforcement agencies. So in Ghana, we have Bank of Ghana. They are enforcement agencies. So Bank of Ghana will come up with rules and regulations that governs maybe banking sector operations. So if you are an accountant for maybe a bank and then you are preparing a statement, that regulations or that rules that the Bank of Ghana will bring as an accountant for that company, or as a banker, or even as a bank institution, you are supposed to adhere to those rules. So these are the enforcement agencies. We have maybe auditors will also follow the ISA. You see, so these are the rules and regulations that you must follow. So in the regulatory framework, the components, we said we have the accounting standards, which is divided into two. We have the international one, the international financial reporting standards. Then we have the IFRS and then the IAS. Also, we have the local one, which is used by USA, the GAP, the generally accepted principles. And then we have the company laws for every country to operate as a business. You are supposed to follow. You have professional bodies who come up with rules and regulations that every institution must follow. And then we have the law agencies, law enforcement agency. Do we get it? Okay, guys. So let's talk about the 5 IFAC code of ethics. So one, we have integrity. Integrity, that's being honest and truthful. Being honest and truthful. So as an accountant, you are supposed to be what? Honest. You are supposed to be truthful in your day-to-day activities. Let's say the company is making a loss. You don't report a profit. Do you get it? You don't report a profit. If the company is making a profit, you don't reduce the profit amount, or you don't report a loss so that you will say you are evading tax. No. Do you get it? As an accountant. So let's say a typical example is where an accountant refuses to alter an account for maybe their shareholders. We prepare accounts so that for shareholders or management to make decision with it. Yes. So you don't alter, let's say you are massaging figures so that instead of making a loss, you make profit, so that it will project that the company is actually performing well, or the company is making profits, a lot of profits. As an accountant, you do not do that. Accountant, you're supposed to be truthful. You're supposed to be honest in your day-to-day activities. Do you get it? Okay. So now let's move on to objectivity. So as an accountant, you're supposed to be objective. You're supposed to focus on the end result. You shouldn't be biased in your dealings. So you shouldn't let conflict of interest override your professional judgment. So let's say something is bad. Do you get it? But because you are allowing the interest you have in the company, you want to do things to favor the company. No. Or let's say you are an auditor, you are about to audit a firm. Yes, you are an auditor and you are about to audit a firm. But because of the relationship you have with the CEO, because you have a cordial relationship, or the CEO is your friend, you are going to, let's say, if the company is forcing or doing something bad, you will not report it in your audit report, which is bad. It is going to affect the decision you are going to make. So you are supposed to focus on the objective. As an accountant, focus on the objective, the purpose for an action. Do you get it? Yes. Okay, so the next one we are going to talk about is professional competence and due care. Professional competence and due care. So as an accountant, you are supposed to always equip yourself. Make sure you look potent, you look competent enough in your day-to-day activity. Let's say you're an accountant in Ghana. ICAG is having a forum or maybe a section for accountants. You are supposed to be present so that you abreast yourself with the new dealings or new IFRS or new rules that are coming up, so that in your day-to-day activities you can apply them. So you are supposed to be competent. Professionally, you are supposed to be competent as an accountant. Make sure you are always on point. Make sure you are always familiar with new rules and new laws regarding your day-to-day activities. So that is professional competence and due care. Okay, then the next one is confidentiality. Very important as an accountant. You need to be confidential. You see, as an accountant, you'll be working with information that are particular about the company. You'll be working with information that can make and or make the company. So as an accountant, those information must not be leaked. You are supposed to protect those information. You shouldn't, let's say you are an accountant, you have access to the company's finances, and then maybe a friend outside the company wants to know, or even inside the company wants to know about the finances of the company, maybe someone's salary or something. As an accountant, you are supposed to keep that information secretly. You shouldn't reveal or expose the information to the outside person. You're supposed to be confidential. Keep the information. Do you get it? You're supposed to keep the information as an accountant. The last one is professional behavior. Professional behavior. So you are an accountant. You are supposed to be respected in the organization as an accountant. So as an accountant, you are not supposed to engage yourself in fraudulent activities. You are not supposed to engage yourself in activities that is going to tarnish your integrity. Do you get it? You are not supposed to engage in an activity that is going to destroy your reputation as a professional accountant. Do you get it? All right. So let's say the company wants to maybe engage in activities which you know is bad. As an accountant, you don't engage or indulge yourself in such activities. You don't engage yourself in it. You are supposed to maintain your professionalism as an accountant. Do we get it? That is the IFAC code of ethics. IFAC code of ethics. Integrity, objectivity, professional competence and due care, confidentiality, professional behavior. As an accountant, keep these 5 ethics with you wherever you will go. These ethics are supposed to be with you wherever you will go. All right. So now let's move on to conceptual framework. Conceptual framework. The conceptual framework. So the conceptual framework is more like a constitution. It's more of a constitution which guides the preparation of financial accounts, financial statements. So conceptual framework, there are no rules like the regulatory framework. We said the conceptual framework are rules and regulations that guide the preparation of a financial statement. But for conceptual framework, there are no rules, there are no regulations, they are just principles. They are just principles that you follow in order to prepare the financial statement. Do we get it? So it serves as a guide for you as an accountant in your preparation of financial statement. It is not, there are no rules. There are no rules that you are supposed to strictly follow before you prepare the financial statement. No, they are just guidelines. So the conceptual framework are guidelines. They are principles that guides the preparation of financial statement. Do we get it? Keep in mind, there are no rules. They are principles, or framework is a framework that guides the preparation of a financial statement. But for regulatory framework, there are rules and regulations that must be followed in the preparation of financial statements. That's the two. This one guides you, there are framework that guides you in the preparation of the financial statement. And in this one is a rules that guide you in the preparation of the financial statement. Do we get it? All right. So for the conceptual framework, they set up the standards that you must follow. So we have standard like IAS 2. IAS2 talks about inventory. So let's say you have inventory. How are we going to report or recognize the inventory in our books? The standard will tell you how you are going to do it, but they're not going to tell you how you should do it. They are just going to give you the framework as to how you are going to report it, but they're not tell you you're supposed to do it this way. The rule says do it this way. No, the standard doesn't tell you to do it this way, but the standard tells you how you can do it. Do we get it? How you can report it, but not how you are going to report it. You see the difference? Yes. Okay. So that is the conceptual framework. There are principles or the principle that helps you in the preparation of the financial statement. We have purpose. Why do we have the conceptual framework? Why? What are the purpose? Why do we even need a conceptual framework? What is it going to do for us? What are the benefits of a conceptual? The purpose of a conceptual framework, one, it helps IASD slash FASD when developing standards. So we know that the IASB, they are in charge of, at the right time we'll talk about the formation of the IASB. Alright, so we know that the IASB, they are in charge of the IFRS and the IAS, and then the FASB, that is the Financial Accounting Standard Board, they are in charge of the GAAP for the US GAAP. Yes. So the conceptual framework, it helps the two bodies, when we are developing the standards. So when IASB is developing the IFRS and the IAS for the preparation of accounts, it is a conceptual framework that they are going to follow in developing it, because I said it's more like a foundation that guides the preparation of a financial statement. So when the IAS are being developed, they look on the conceptual framework in order to be able to prepare, or in order to be able to generate or develop the standards that will be used in the preparation of the financial statement. Do we get it? So let's say when they were about developing maybe the IAS2, yes, IAS2, let's say when they were about developing IAS2, they will go to the conceptual framework, go through it, understand it, and then generate what they need to develop the IAS2 that we have now. Do we get it? So yes, it helps them develop the standard. Then we have 2. This one helps preparation of accounts when no standard. So in the absence of no standard, it is the conceptual framework that an accountant is supposed to go through in order to prepare financials. Do you get it? So in preparation of the financial statement, in preparation of the financials, an account, and then there is no standard like the IFRS or IAS. When there are no standards, the conceptual framework serves as a guide in order to prepare the financial statement. Very simple. It serves as a guide in the preparation of accounts. Okay, so the next one we are going to talk about is helps users understand financial statement. So the conceptual framework is there to help users of financial statement, which we've already spoken about it. We have the investors, we have the shareholders, we have the employees, you understand, regulatory bodies. So these people, they need the financial account, the financial statement. So the work of the conceptual framework is that it helps these users, those who are going to use the data, to understand, to comprehend the information that the accountant has prepared for them. Do you get it? So where they do not understand, the conceptual framework is there to provide the understanding for them, the users, for them, so that they can make informed decisions. Do you get it? Yes. All right. So the last one that we'll talk about, there are many, but we are just talking about this, is it enhances it enhances consistency / comparability. So we say the conceptual framework enhances consistency. So when we talk about consistency, let's say when we adopt a particular standard that we are going to use for the preparation of a financial statement, we are supposed to be consistent with it, so that in comparing year after year, you would understand it will match. Do you get it? So the conceptual framework is there to help enhance the consistency, but they will come up that financial statement is supposed to be consistent. Do you get it? Financial statement is supposed to be consistent and then comparable. So they help in the consistency and the comparability of financial information. Do we get it? Very simple. So these are the purpose or the reason why the conceptual framework is there. It is there to help the ISB and the FASB to generate standards for accountants, helps in the preparation of accounts where there is no standard, helps users understand financial information, and then also it enhances consistency and then comparability. Do we get it? Now let's talk about what the IASB is. Let's talk about what the IASB is. So the IASB, the full meaning is International Accounting Standard Board. So this is the full meaning, the International Accounting Standard Board. The International Accounting Standard Board that we have now came into existence in the year 2001. In the year 2001, to replace the IASC, the International Accounting Standard Committee, which was there since 1973. So International Accounting Standard Committee was there since 1993. They were coming up with the standards. And then in 2001, they dissolved this committee and then they formed the International Accounting Standard Board. So this board came to replace this. And then now this board is in charge of the standards that we have now. Do we get it? Yes. So the first accounting standard came in the year 1975. Because this was in 1973, the first standard came in the year 1975. That was when the first standard was developed. Do we get it? Yes. So that is it. Then that is the brief information you can have on the International Accounting Standard Board. All right. So now let's move on to the characteristics of, let me do it here. Characteristics of financial information. So let's say when you take financial information, what are some of the characteristics of that financial information? So let's say an accountant in your company has prepared a financial statement. We have the profit and loss, we have the balance sheet, we have changes in equity, we have the cash flow, statement of cash flow. All this information has been prepared for you. Yes, as a worker. Now we want to see the characteristics that will make that financial information that the accountant has provided a good one. What are some of the things that will make the financial information a good one? One, they say the financial information must be relevant. So where the financial information prepared cannot serve a purpose, then the financial information, it's not a good financial information. We don't need it. We need the financial information to make informed decisions about the company. But where we cannot make decisions, where it is irrelevant to make decisions, then the financial statement is not needed. So we need it. So it's supposed to be relevant. Do we get it? The financial statement is supposed to be relevant. Then two, we have faithful representation. Faithful representation. So you have a financial statement, and then the financial statement is not representing the true state of the company you are in. Let's say the company is actually suffering, the company is making losses. But when the accountant prepared the statement is showing that the company is making billions and millions of profits, which means the statement is not reflecting the true state of the company. Do we get it? We have, let's say, asset. Our asset is it has devalued. Then the accountant is saying that the asset is gaining value. The company, the goodwill of the company is gaining value. While we know the goodwill of the company is devaluing. Do we get it? Yes. So the state of the company must faithfully be represented in the financial statement. The accountant shouldn't misinform users. Yes. Okay. So, and then we have comparability. Comparability. The financial statement should be able to be compared firm by firm or years by years. So let's say financial statement for 2023. I should be able to compare that financial statement to 2024 so that I would know that yes, indeed the company performed better than the previous year. Okay, so we have entities that work in the same line of business. Okay, so let's say a company that deals in cars, two companies dealing in cars, they are the same business. So I should be able to compare my financials to the financials of the other company. So company A deals in cars, company B deals in cars. I should be able to compare the financials of company A and company B. That makes the financial statement or the financial information a good one. So a good financial information must be comparable. All right. Then the next one is verifiability. So the financial statement, we should be able to verify whichever information that has been provided. Let's say when we take a professional observer, let's say someone who is not in the business, someone who is outside the business, and then the person should take the financial statement, it should be able to relate. Do you get it? There should be consensus. The observer should be able to agree with what the accountant has prepared. There should be that agreement, which means that the outsider has been able to verify that the financial statement is good. If the outsider is unable to verify it, then it means the financial statement prepared is not good. It cannot be used for decision making. It cannot help management in making decisions. Do you get it? Yes. So the financial statement it should be able to be verified. It should be verifiable. Yes. Okay. Then the next one is timeliness. Where you are working on account and then the account is not prepared on time, what is management going to use the information for? The information must be provided on time. I need it 10 a.m. The information must be ready by 8:30, by 9:30. The information is ready. Let's say where we have annual general meeting on maybe 25th January. The information for, let's say, 2024 should be ready before 25th January 2025. It should be ready and audited and then before the general meeting. So the information must be provided on time. The financial statement must be provided on time. It must be ready on time. That's timeliness. And then the last one is understandability. Understandability. So the financial statement should be free of jargons. It should be simple that when an employee picks up, the employee should be able to understand that, okay, yes, the company is making profit, the company is making losses, the asset of the company is this is the true value of the asset. Like, you see, things are, it should be clear for everybody to understand the financial statement. It shouldn't be ambiguous where when someone picks it, the person will not be able to understand it. No, the financial information should be very simple and then understandable. I should understand the financial statement you have provided for me. It should be very clear. It should be clear for everyone to understand. The users of the, because let's say an investor, maybe he might not have accounting background, and then you've gone to, let's say, instead of let's say instead of I want something, instead of maybe account receivable, instead of writing account receivable there, you've gone to write AR in the balance sheet, AR or AP, account payable, instead of writing. You see, if an accounting person takes it, the person will understand that AP is account payable. But what of the person who doesn't have the accounting background? The person wouldn't understand. So it should be less of jargon so that everybody would understand. You know, we have accounting jargon that they use, yes, but it should be less of those jargon so that if a mere person who takes it, the person would be able to like comprehend. You should be able to understand it and then make informed decision. As an investor takes it and then he's seeing AP, AR, those things, those jargons, the person wouldn't understand. The person will be like, what is this? What is that? Now that the person is going to ask for help and those things, but the person should be able to understand and then make instant informed decisions. Do we get it? Now let's talk about the threats. Threats to the fundamental principles. So as an accountant, we have threats that can affect you in your day-to-day activities. So those threats we have, let me put them here. We have one, we have the self-interest, we have self-review threat, we have advocacy threat, we have familiarity, and then we have intimidation. So let's pick it one by one. So self-interest threat. What is self-interest threat? You are in a company, you have personal interest aside the company's interest. Let's say you have invested in the company, you have shares in the company. Do you get it? And then when the company makes profit, you are going to get your dividend. So what do? You are going to fluctuate figures, pump figures. You understand? You are going to make sure that you are going to massage the figures so that the figures will be looking attractive, so that shareholders will pay you your dividend. Which is wrong. You have personal or self-interest in the company. Personal interest in the company. Once you are working for the company, you shouldn't have personal interest in the company, so that it will not affect your day-to-day activity. Do we get it? So don't have personal interest in the company. Make sure you do not have personal interest in the company you work for as an accountant. All right. And then we have the self-review trait. So let's say you are an auditor. And then you are reviewing your own work. You are an accountant. You are reviewing your own work. You work as an accountant, and then at the same time you work as an auditor. Meaning the work that you've done, you are assessing it yourself. If there are mistakes, you will not point it out. If they have misleading information, you will not point it out, because you are reviewing let's say you have interest in the company and then you are the same person reviewing it. How are you going to tell the management that, I myself I did this and then I have pumped figures in it, I have made massage the figures, and then the figures are not, they are not representing the company faithfully. So no, you are not going to do that, because the company is your own. More like you have shares in the company, you have interest in the company. So you shouldn't review your own work as an accountant. After working, someone is supposed to review the work you have done to ensure that yes, the information provided matches the true and fair state of the company. Do we get it? Okay. Then the next one is advocacy. You are an accountant and then you are acting at the end of acting as a marketing officer for the company. It doesn't work that way. as an accountant, you work on accounts. Let someone be the spokesperson for the company. You shouldn't go and then be defending the company outside. The company, if the company wants someone to defend them, they should have a PR who will be working for the company. As an accountant, you don't go and work as a PR. As an accountant, you don't go and market products to outsiders. That is advocacy trait. Do you get it? You're advocating yourself to do things that you're not supposed to do. Familiarity trait. So you're an accountant, you've worked in the company, you are an auditor, you've audited accounts for a company for more than let's say 10 years. And then you be familiar with the people in the company, the CEO will be your friend. So whenever you come around, they've brought food to your table. You are not going to tell those who employ you as the shareholders or board members that, oh, this is what is happening. Because you are there, they are treating you good, you are familiar with them, you are friends with the CEO, you are not going to do that. So that is why most firms, after 5 years, they reshuffle, new faces will come, they will go and audit, and then you will be auditing a different firm. They will be more like reshuffling in after every 2, 3, 5 years. You get it? So you shouldn't be familiar. Imagine me, I'm an accountant and I'm going to audit a firm, or I'm going to audit a firm, or maybe my father's firm. Do you think I'm going to faithfully capture everything, every wrongdoings of the company? No, I might overlook certain things. Do you get it? But if, let's say, someone else is coming to audit my father's firm, the person doesn't have any connection with my father. There's no familiarity. So meaning the person is going to audit the firm and audit it very well and make sure that he reports every misleading information in his audit report. That is what we term as the familiarity. And then intimidation. Let's say the CEO is intimidating you. Let's say is telling you that when you do not do this, I'm going to fire you. That is intimidating. It is intimidating your work. That is going to affect your principle as an accountant. Do you get it? It's intimidating. You might do things that you do not want to do. You might follow his lead. You might want to do, let's say in Ghana that we don't have, getting the work to do is very difficult. And then you've gotten yourself one work, and then the CEO is saying that, oh, instead of reporting a loss, report a profit, so that our company will look very nice to the outside world, to our investors, to our shareholders, so that they will pump more money into it. They will be like, okay, the company is doing well. Or instead of reporting a profit, report a loss, so that we will not pay tax. If you don't do it, I'm going to sack you. If you don't do it, you are going to lose your job. As an accountant, what are you going to do? This is very intimidating because you've actually suffered before getting the work. What are you going to do as an accountant? This is a very difficult state for anybody to be in. It takes integrity to stand on your feet. Do you get it? Yes. So these are some traits that can affect your day-to-day activities. All right. Thank you for listening to KS Tutorials. Thank you for watching us. My name is Mr. Sam. Continue watching us. Continue liking our videos. Continue commenting. Let us know what you find difficult in accounting. Comment it, and then I promise you I'm going to make a video giving you detailed information or detailed understanding, detailed explanation of whatever you are going through. Keep watching us. KS Tutorials. Keep calm. KS Tutorials. Balance on.